So we're going to slide right into the next session. So thanks for being here. What we're doing here is, this is sort of an offshoot or the onstage version of a Localogy video series that I produce and host called the M&A Roundtable. But interestingly, it's gotten a lot broader than just M&A. We're going to go through a range of sort of investment topics. And you guys can actually come on out. Carrie, you guys can come on out. So through the lens of what these gentlemen are each working on, we're going to go through a range of investment topics beyond just M&A per se. So why don't we do this? Why don't we each have each of you guys introduce yourselves, your roles, and your company, and then we're going to go a little bit deeper into your sort of investment theses, or Josh, what you're doing in the sort of M&A advisory work. But first, name, title, role, company, all that good stuff. Kerry, you first.
Hi, Kerry Ransom. It's great to be back. I mean, it's amazing how many old friends after I think I spent about 10 years in this in this world.
Back in your Web Visible days.
Yeah, and Reach Local. And I mean, God, just amazing.
Merchant Circle? Were you in Merchant Circle for a
I was
while?
involved with that. And actually, I was an advisor there. So it's been good to be back. And I actually have a couple startups that are now playing in this world a little bit too. So I run a venture studio called Operate. We were started about almost 2 years ago with the idea of really partnering with early stage founders. So we often are first check, willing to embed people into these early stage companies that are always lacking in resources and capability, and try to co-build and really help them go on a more successful, faster, more capital efficient early journey.
And you've been on both sides of that table, so we'll get into some of that perspective as well. Sean, tell us about yourself, your role, and your company.
Yeah, thanks. Sean Duncan, I'm a partner at the Riverside Company. The Riverside Company is a global investment firm with over 12 billion in assets under management, 9 different funds internally. I'm part of the growth equity fund. So we're typically investing in companies that are later stage, software, internet oriented, have typically 30, 40, 50 million of annual recurring revenue, growing over 50% year over year, have a path to an IPO within 2 to 3 years. Previous to Riverside, I've been in tech my entire career, but worked on both the banking private equity side as well as the operating side. So worked at 2 different software companies. Most recently, prior to Riverside, I was at Salesforce doing M&A for 3.5 years.
One of the most acquisitive companies in the world of the last decade. You were in M&A there. That's very interesting. We can dig into that. Josh.
Hey guys, Josh Sherman, the founder at B2B Software Advisors. Believe it or not, we mostly focus on B2B software, where we do M&A and strategic biz dev. And chose to focus on that. I spent my entire career across operating in the B2B space, most notably at Constant Contact, and then spent a number of years back on the banking side, doing mostly sell-side M&A, and really combining both of those things now at my firm, where I really want to help clients take a longer-term view as they're thinking about exiting their business and starting to invest really early in important relationships that'll help them get there. So excited to be here.
Great. So one of the challenges here is to have a cohesive discussion, because you guys have such a great sort of range of perspectives. So we've got a lot of great diversity here. And some of you guys already went into this, but I'd like to flesh out where you each are. Josh, you're doing M&A advising. Is it buy side, sell side? What sectors? Kerry and Sean, with your investment hats on, thesis, deal size, sectors, stage. Sean, you already mentioned some of that stuff, but Kerry?
So I would say, if I look back at my career, I think I've done like 10 startups. And so the common thread of what really excites us is when software and data get intertwined. And so that's kind of almost, we have about 20 companies now, and I think 19 out of the 20 have that as kind of the central core. That can be a consumer business, that can be a B2B business. And we're often, again, willing to start as early as the founder when we meet them. Yeah. I tell a lot of venture funds that if you see something that's too early for you, it's probably never going to be too early for us if we can get really excited about it and see how we can add value. So we like, and I think the era for us, and it goes back, I mean, you mentioned Web Visible. Web Visible to me was this big missed opportunity, because we didn't ever build a closed loop, smarter software engine that kept getting better and better over time. And so I look back at a lot of my career and say, there's still a lot of that software in the world, and the next phase will be a much more intelligent
Yeah.
set of software tools, and I think that's the kinds of capabilities that we're often looking at. And often we'll even meet founders who haven't fully realized what they might be able to do yet with machine learning or AI or prediction, and so that's part of the value that we even bring as we start to look at what might be possible.
Well, you may or may not have seen it yesterday, but Afif Khoury at Sochi made that exact point, closing the loop, and that's becoming more and more possible because we're no longer just talking about marketing and customer acquisition, but a lot of these operational tools that are sort of, bringing that full closed loop data to bear, CRM, POS, all those good things. So Sean, you mentioned some things that already really characterize your thesis. I think you said late stage, growth equity. Any verticals, any other kind of details you want to give us to flesh out what you're kind of looking at these days?
Sure. So we consider ourselves opportunistic growth investors focused on primarily software and internet companies. And these are typically category leading companies, so companies that already have product market fit, already have 30, 40, 50 million, sometimes 100 million plus of annual recurring revenue, growing 50 to 100% year over year, and typically companies that have a path to an IPO. So we're relatively late in the game, and we are, given the valuations these days, which we'll talk about, in many cases we're willing to pay up because we have true conviction in the company and the long-term potential of the business. And in terms of check size, we're very flexible, so we can go as low as 5 million, and we've written as large as a $55 million check. So it's very opportunistic.
Nice. Josh, you focus on SMB, I know. Any other things you want to flesh out about your approach?
Yeah, I wanted to continue focusing on SMB, just given my background and the time at SurePath as well, but I've certainly expanded more broadly into just general B2B software in general. However, spending the majority of my time doing either mostly buy-side M&A at the moment, representing some large PE-backed strategics who are executing some type of a roll-up, as we're seeing that's very hot at the moment, which I know we'll also talk about. But being a little bit picky on the sell side, because just from what I saw on the sell side, you read about a lot of transactions that happen, and it's always exciting. But I found, as someone who, we were able to get a lot of sell side stuff done, but it's incredibly challenging. So as I wanted to branch out on my own and think about how to focus, I try to not take on too many sell side opportunities unless there's some very clear intent already coming inbound to the company, and really try to lean them more into a longer term vision around the strategic biz dev side. Like, let's take some time, let's invest in some partnership channels, things that I'm really well versed in just from my time as an operator, and try to tee up a sell side down the road for them. And then in terms of company size, it seems like right now the sweet spot for me is certainly companies that are probably, haven't quite hit 10 million of ARR, and are looking to either accelerate their growth through partnerships, or are at that inflection point where they're receiving inbound interest, or they're just seeing what's happening in the market and they want to take advantage of that. And at that point, we can be really helpful to those founders.
So all three of you, I'm realizing, have that operator background, Web Visible, and that long list you mentioned, Salesforce. Josh, what does that list look like for you? I know Constant Contact is somewhere on that rap sheet, right?
Yeah, so when I left banking originally back in 2009 and jumped into tech, I landed serendipitously into the local space, the SMB software world, where I joined a small startup called Postling, which was in the social media management space, kind of even pre-Hootsuite. And that just sent me down this path. So then I spent time at Constant Contact, where I led all their technology partnerships, built out their API program. Also, again, deep in SMB, just kept falling in love with it. That's how I got to become part of this community here. And then jumped over to Indenero, which was cloud-based accounting and bookkeeping for small businesses. So I just developed this passion for the local space. I love all things local. As shitty as COVID was, it's been amazing to see the technology adoption across all of the local businesses in my community, and I love seeing that, and I just am so bullish on the opportunity now for these businesses to grow using these software tools that have actually been out there for a really long time, and they just were the inertia of it. It was really hard to switch, and so I'm really excited now to double down on that and to help. I'm really bullish on how M&A can solve for that. There's a lot of tools that should not be, a lot of companies that should not be independent. I think they would be better served, as part of a bigger company, or maybe a couple need to come together. There's a lot, and that also is very overwhelming for businesses. So I think it's been really fun now jumping over to this other side for these last 5 years now, and kind of getting into this M&A game. But the operating side has been huge, because I'm really am able to evaluate things, I think, through a different lens than just a pure banker who never had a chance to spend time inside of a company.
And one of the things that's always been the appeal of local, even though it's a headache, it's fragmented, all those challenges we all know about, is the headroom that's still there. The adoption is still so low, so pre-pandemic that has accelerated, but still there's all that headroom. So speaking of COVID, let's talk about, there are COVID advantaged sectors, obviously. All things digital, all things software, SaaS, continues to be very attractive, even though that's a pre-pandemic phenomenon. E-commerce. When you look at all of that, how has your approach and everything we just went over kind of changed? A lot of it is just sort of your fundamental strategies, but was there any sort of pivoting that you guys did over the last year and a half?
Yeah, I think the biggest one for us when we first started, a big part of our belief was we need to be as co-located as possible with these early stage founders, and that has completely blown up, and so much so that I gave up the sort of co-work space that we originally took on because 3 months in, nobody was showing up there anymore except me. So I think that's opened us up to say, hey, we have to meet people where they are and figure out how to use a lot of these tools and capabilities themselves. And some of that was a hangover from almost 20 years ago.
Yeah.
I started a company with 2 founders. We were all remote, and it didn't work. And I said, hey, all things being equal, let's figure out how to be together. And I think we've figured out that is possible to still succeed without that. And so that's probably the biggest adjustment we've made. I think otherwise, we continue to try to look to the other side and say, we're planning for 8 to 10 years out. So what's the world likely, or can we start to forecast what it's likely to look like as things come back together? So maybe we've adjusted some of that lens, but otherwise, most of what we believed 2 years ago is still largely true.
Now that sort of procedural sort of factor of, the diligence, the meeting with the startup, all of that, that's interesting. Do you see second order effects of that of, it's no longer a requirement for a startup to be in the Bay Area and pay Bay Area rates because they need to be near Sand Hill Road. And then, on the other end of the table, you have sort of maybe a wider kind of locus of relevance because you're now targeting and working with companies that are beyond a 30-mile radius.
Absolutely. I mean, I had a call with a founder yesterday who he was pointing to his 2 biggest competitors. He said one has 150 people sitting just off Market Street in San Francisco. The other one has 125 in Cambridge, Mass. And I'm going to put almost my entire team in Eastern Europe. And I think that cost advantage allows me to invest back into marketing, and I'm going to do my best to take advantage of that. And so I think there's all kinds of new models that, haven't necessarily been fully new, but people are going to look at the entire revenue or P&L stack and say, where can we improve our advantage?
What was preventing that before? Habit? Interesting. So Sean, any new perspectives or strategies that you've enacted in the last year and a half?
Yeah, so I think we've all heard a lot about this whole idea of digital transformation, which has been ongoing for many years now, and Salesforce, in fact, actually built an entire M&A practice around it. But this whole notion of digital transformation, historically, I've focused more on enterprise software businesses, but now, given what's happened with COVID, our team's actually been spending a lot more time on more SMB, local-oriented software businesses. Just given the ongoing change there, I think we've hit a certain point now. In a way, it's a tipping point where a lot of these local businesses are realizing the importance of technology, and we're seeing some fantastic software-oriented local SMB companies that are just growing extraordinarily quickly at that 20, 30, 40, $50 million ARR range. That have really piqued our interest. So we're spending a lot more time there, given the ongoing change.
And larger companies that are moving down market. Salesforce has been doing that for a while, of course. Intuit just bought MailChimp, big sort of customer acquisition play, among other things, at that sort of lower market SMB level, which, as we know, is hard to get on your own without channels or acquisitions. Josh, your thoughts and new perspectives of the last year and a half?
I think just maybe looking at just purely through the M&A lens, it's been crazy to see how accelerated things have become and how much activity there is when people, at least when COVID hit, everyone thought the world was ending, and now it just seems like there's so much investment being made. I think that the technology acceleration is just like nothing anyone's ever seen. And so as I'm having calls with founders, I think there's a little bit of the shift also is maybe a little bit on the personal side for the founders. It's just a different calculus now. I think after what everyone has just been through, at least, I'm not doing the MailChimp deal. I'd love to have done a $12 billion deal, but I'm not doing those types of deals. I think it's really, a lot of smaller, let's call it sub, $25, $30 million deals right now that are, that's really fundamentally life-changing to a lot of these founders. And I think they're just seeing all this activity. They're seeing what COVID did to their life. They're seeing, the ability to now work from anywhere, and that they could start new companies, and maybe it's time to cash out for them at this current one. And it's just funny, there seems to be a lot of the conversations I'm having right now are from folks who are like, it just feels like the right time to cash out. I want to start something new. I'm seeing this incredible new opportunity, and I want to fund it myself. Bootstrap's becoming a thing. And that's just more so than pre-COVID, where it was all venture-backed companies looking to exit and at different level type multiples. But the acceleration around folks just wanting to exit, cash out, and start something new is something that I didn't expect to see, pre-COVID.
Mm-hmm. So let's sort of pan back from COVID and talk about the overall environment, which is, known for a lot of sort of factors, some foreseen, some not. We have now more money in market, which may or may not provide more leverage to startups, to acquisition targets. It's in some ways sort of a seller's market in that respect. We have a separate trend, which is companies staying private longer to avoid the sort of rigors of the public markets, and they can do sort of non-public liquidity events that are now available to them. Again, more leverage there. At the same time, we have this rise in SPACs. So like all of these things, whether they're related or interrelated, I mean, pick any one. What's your guys' kind of view of the current environment and how you're sort of rolling with some of those macro factors?
Yeah, I think I mean, I'm an optimist, so I think for me it's amazing because it says, hey, there's a whole bunch of different ways to do this, right? There used to be almost like a single pipe. You have new competitors, I have new competitors. We all have to come up with our way of how we're going to add value. It's not just capital. It's not just advisory. I think that's what excites me about it. I mean, I've one company we've invested in that's going through an equity crowdfunding. I think they launched it yesterday or maybe today. Another one that's down the path and is probably going to do it as a supplement to their current round. That didn't exist just a few short years ago, and certainly not as a legitimate way to add value into a company where you're now giving all of your customers presumably an opportunity to own a piece of it and be on the ride with you. So I think there's just so much that is available now that anyone that says this is the way you have to do it, you probably have to dig a little deeper and figure out what's their angle or what's their vested interest in suggesting that, because there's a whole set of options. And I think that's what's exciting to me is I get to be almost a problem solver on each unique opportunity we get involved with.
Keep you on your toes.
I think the most striking difference to me now relative to 12 or 18 months ago is just the valuations.
Yeah.
So I think Series A's were getting typically done at 5 million on 20 million pre 4 years ago. Now it's 20 million on 80 million pre. I'm seeing growth investors, later stage growth investors, now moving down market toward the Series B rounds. And some of these companies, I've seen companies that are raising at 100 to 200 times ARR. I mean, it's happening pretty regularly, which is, we're not doing those types of deals. It's tough to wrap your arms around. And I think just given what Kerry was saying about new entrants in the market, we're just seeing a lot of hedge funds, mutual funds, sovereign wealth funds coming into these mid to late stage growth rounds, which is just making things a lot more expensive and competitive.
Yeah, and for me, it's the continued rise of private equity. I think that has, for a long time, it felt like every founder wanted to exit to a strategic, but now private equity is strategic in the multiples that they're paying, particularly for the good ones, which is why I do think it's important to try to find someone you can count on to make sure you're talking to the right firms, because speaking of valuation, the valuations I'm seeing PE pay for for a majority buy or an outright buy on a good, healthy, growing SaaS business is strategic level at this point. And that's a trend that I think is going to continue. There's just so much capital, and it's the most exciting as I think about founders today. And I would encourage all founders to be exploring, that as an option beyond just the strategic outcome, because it's really amazing to see how much capital has flowed into private equity, and that private equity isn't what it necessarily used to be, particularly on the SaaS side, right? It isn't all barbarians at the gate. They just want to come in and destroy a company. There's actually some incredible operators at a lot of these funds now where they want to own and operate and grow a business. And there's great opportunity for founders to sell, roll some equity into a new asset, then go after that kind of 2 bites of the apple, cash out at that initial close and then roll some equity into the new asset and have a chance with now some new professional operators who their goal is to, 3 to 5 exit is to, and kind of tie yourself to them for a little bit. So that's been an exciting trend that I'm personally a big fan of.
Yeah, I think just one quick comment. I mean, I agree. I feel like it's never been a better time to start a company. And even if you think the end of this incredibly long cycle is probably near, it still feels like it's never been a better time. And I find it fascinating that you mentioned earlier that you have some founders that are a little bit later in the business going, I need to get out of this one so that I can start the next one, because there are just the categories of new innovation are amazing as well. So yeah. I think that's what's so exciting too.
Mm-hmm. So let's show rather than tell. Any deal involvement recently, any things you want to point to as sort of mini case studies of any of these sort of phenomenon that we're talking about, and in any order, if anyone wants to jump in, and something you've done recently that sort of exemplifies the environment.
Sure, I'll go. So one company of ours that recently went public that we invested in 2019 is UiPath, which at the time we invested at the round they raised at $7 billion, and I think it was at 38 times ARR, which at the time was crazy. But we viewed it as a category-leading company where the technology was incredibly difficult to replicate. We had never seen net dollar retention as high as it was. They were growing over 100% at over 100 million of revenue. Just a lot of those types of characteristics that we're looking for, they were one of the few that had it, which justified us paying up for that round.
What would you say today? It's probably hard to pinpoint because it's sector dependent, but the ARR multiple that we're looking at today, say in just SaaS?
I think it really is tied to the growth rate, but on average, I'm seeing for top tier assets, 40, 50 times now. Yeah. Whereas like a year ago, it was more in like the 25 to 30 times range. It's just gone up exponentially. So we'll see how this evolves, but that's a reality.
That's where we're at.
Yeah, we can. I mean, just to build off that. I mean, growth is the single largest driver of valuation, and they're usually on the M&A side. You see this, incredible ARR multiples that are happening. Anything growing north of 50%, or maybe even 40%, frankly, because at this point everyone's just trying to throw capital. But there is a significant drop-off, and I think what ends up happening is it's frustrating to see companies who aren't growing that fast want that valuation, and then you're just at
or they've reached a point of maturity, which should be a positive, right? And then that actually lessens their multiple. Right. Yeah.
That's their unfortunate purgatory.
Yeah. And we run it. I mean, we meet a lot of founders that don't fully they just see the headline numbers, and they're not looking at their own business and saying, oh, what's our growth rate relative to the market or competitors, and we should just get that, because I mean, even sort of multiples far under that are still really, really attractive for capital. Or I mean, we had one of our last investments in our first fund sold earlier this year to Gusto, and it was Gusto's first acquisition. And part of his calculus was, hey, I've got a great business going, and they've got 200,000 customers. I have 200. They really want to buy something in this space. I probably have the cleanest cap table, and I can pull forward my value and get on a highly appreciating, fast-growing train that it gives him an opportunity probably to cash out a little sooner than being only a couple years into his business. So it wasn't a 100x return for us like we would hope, but it was a great return in a short period of time, and we now own shares in a UiPath-like category defining company that'll go public here probably in the next year.
Were they partners with Gusto before they sold?
They were.
Yeah.
And that,
Yeah.
I think we then now look and say, okay, now we have a friend on the inside.
Yeah.
There's some other businesses we should think about there, because to your point earlier, the sustainability of 20 tools in a small business is not long, right? There needs to be better integration, better consolidation, because they're getting fatigued like we are in the enterprise as well.
So I'll signal the audience, if you have questions, step up to one of these mics, I'll see you. But let's keep going. Any other sort of direct deal involvement that you guys want to, of recent past that you want to underscore?
We have one that, it kind of brings me back into this. So we just launched, literally in the last couple weeks, a company here in LA called Mustard, and it's somewhere between consumer and SMB around restaurants, and we're taking this strong desire that consumers now have for video as a core experience to bring it into restaurants, and you've got foodies all over the place taking video, posting it. We've built more interactive capability into it, so where now this can become the menu for the restaurant, and I can use that to order from home. I can use that to get an experience of what the food's going to be like before I go to the restaurant or while I'm at the restaurant.
So it takes that fragmented base of content, all of those separate videos, and automates the sort of aggregation and polish of. Right. Nice.
And we've got intelligence, so we know what dish at what restaurant, and then allow people to engage with it in an interactive way, like you would see more shoppable content on some of the social media.
Mm-hmm. So we have a question here. Go ahead.
Hi. You were talking about growth rate as sort of the number one driver for valuation. How much do you care from your perspective what comes from organic growth versus acquisition growth?
We prefer it to be organic, but I think there's a lot of great companies out there that have, in a way, taken advantage of this multiple arbitrage in the public markets through M&A. I mean,
Yep.
Salesforce is a really good example. Salesforce has done $80 billion worth of M&A in its history, and they're a $250 billion market cap company now. So while I'd say, like when I'm sure when you look at companies relative to M&A, and when I'm looking at companies, whether through investment or M&A, I'm always looking at the organic relative to the inorganic growth rate. But I think if there's a story to the inorganic growth rate and the growth that it can drive in the future, I definitely think there's a very healthy multiple that you can apply to that.
Thank you.
So Josh, you didn't get the chance to talk about any recent deal involvement or anything like that. If you want to, you can. If not, we'll go on to the next.
Well, I just want to highlight, I think for me, as I thought about that, it was, I'm almost building off the point I was trying to make with the Gusto exit you had. So when I started my firm with the thesis of your most likely buyer is someone that you're partnering with. I mean, that's just what you see. It's not anything new, but the reality is a lot of people don't invest in that. And for me, I'm really excited. Like the 3 active deals that we're in the midst of right now, which are all in a post-LOI stage, are all partners of the acquirer. And so I'm really excited, and I want to keep just leaning into that. And it wasn't, the 2 guys I'm on 2 on the sell side where it wasn't a full process. It was, these guys came into them, and it didn't make sense for them to go run that. And then my client on the buy side that we bought, it's the same thing. It was an intro we were able to bring into them earlier this year. And then now the timing was right, where kind of the stars aligned. The product team was really looking at the space, and they were the natural company for them to go after. So like the messaging is just more around, continuing to invest early in important relationships. If one day your goal is to exit the business, it's better to likely be able to call up the people who are your best partners in that end.
Sure, it's you already acclimated and sort of the rent-to-own principle, right?
Right, that's right.
So we're actually almost out of time. Why don't we do this for the last sort of down the line sort of question? What advice do you have for the folks in this room if they are either seeking funding or seeking to be acquired, or any of these things that you currently are working with and seeing? What's your advice to these folks?
Yeah, I think it is to what Josh was saying. It's figure out what you're going to do so much better than anybody else in the world, and then find partners, find other ways to grow and expand your approach, because you can't do it all. You can't build it all, and you just have to figure out how to move quickly and increase your growth rate.
Nice. Sean?
Yeah, I think it's all about product specialization, differentiation. I think beyond that, what we're seeing is, and the types of companies we're looking to invest in are companies that can find ways to cross-sell different products across their customer base, especially as it relates to these more SMB-oriented businesses that have 40, 50, 60,000 customers, finding new products and looking at what the attach rate is across those customers. I think that's something that we really like to focus on.
Nice.
I'll just double down. I mean, on what I said before, invest in partnerships and invest in relationships. And those are related, but sometimes relationships won't turn into a formal partnership, but allocate time and invest in those key relationships.
Nice. Well, this has been incredibly valuable. Please join me in thanking the panel.